Tensions rise in Silicon Valley over sales of startup stocks. Introduction: the bustling ecosystem of Silicon Valley, where innovation meets capital. The dynamics of startup investments have taken an intriguing turn with the advent of the Destiny Tech100 fund, launched by entrepreneur Sohail Prasad. This fund represents a novel approach to investing in tech startups, specifically targeting hot companies that are on the cusp of significant growth and success. This development raises various questions and concerns among investors, entrepreneurs, and the broader tech community. Background of the Destiny Tech100 fund: the Destiny Tech100 fund, introduced in March, has quickly garnered attention due to its unique focus on acquiring shares in promising tech startups. Unlike traditional venture capital investments that typically involve direct funding to companies in exchange for equity, this fund operates by purchasing existing shares from other stakeholders. This method allows early investors and employees to liquidate their holdings and potentially reap the benefits of their investments earlier than usual. Implications for the startup ecosystem: the creation of the Destiny Tech100 fund has significant implications for Silicon Valley's startup ecosystem. Firstly, it provides a new liquidity option for early investors and employees, who often face long periods before they can cash out their shares due to the extended timelines leading up to an IPO or acquisition. By enabling these stakeholders to sell their shares earlier, the fund may alleviate financial pressures and allow for reinvestment in other ventures. However, this new dynamic also introduces complexities. For example, it could lead to shifts in how startups are valued and how equity is perceived as a long-term benefit. There is a risk that early sales of shares might undermine the traditional growth through adversity model that many startups rely on. Furthermore, these transactions might affect the control and decision-making within the startup, as new shareholders introduced by the fund come into the picture. Community and investor response to the Destiny Tech100 fund within Silicon Valley has been mixed. Some view it as a much-needed innovation in the startup financing landscape, providing flexibility and additional options for liquidity. Others express concern, speculating that it might lead to increased speculation on startup stocks, potentially inflating valuations without regard to fundamental business performance. Ethical and regulatory considerations: rise of funds like Destiny Tech100 also surfaces important ethical and regulatory considerations. Regulators may need to scrutinize these funds to ensure they do not create unfair market conditions or contribute to economic bubbles. Ethically, the fund's approach must be transparent, ensuring that all parties involved understand the implications of early stock sales and the potential impact on the startup's future. Conclusion: the Destiny Tech100 fund by Sohail Prasad marks a pivotal moment in Silicon Valley's ongoing evolution. While it offers innovative solutions to some of the financial challenges faced by stakeholders in the startup ecosystem, it also brings forth new challenges and concerns. As Silicon Valley continues to adapt to these emerging financial instruments, it will be crucial for all parties to navigate these changes thoughtfully and responsibly, ensuring that the spirit of innovation and entrepreneurship remains undiluted. Ultimately, the success of such ventures will hinge on their ability to balance immediate financial benefits with long-term sustainable growth for the startups they invest in.